No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host, and we're going to be talking taxes. It's tax season. Woohoo! How many people feel that they pay too little in taxes, right? Even with the tax cut, is there anyone, and that's the whole thing about the tax cut. It makes everybody a little excited, right? Is that everybody's going to save on their taxes. We're going to talk about a little bit about how the new tax laws are going to affect you for this year, so we can do a little tax planning at the same time, because it's a great time, right? We're talking about taxes. We're getting into the tax season right now, so we're going to be filing taxes for 2017. This is a time when we'll talk a little bit about strategies that can still be employed, ways to maybe reduce your taxes or avoid penalties, and some of the things in the tax code that can trip you up, watching out for 1099 mistakes, a bunch of things we'll get into to do with this year for filing your taxes. But also, since we're doing taxes, why not start planning for what we're going to do for 2018 and how the new tax law is going to affect things? What are the benefits going to be to you when you file, not only for this year, how you handle that, but also, again, planning for 2018, ways that you can minimize taxes this year, because none of us want to pay more in taxes. And if you do, send them a check. They'll take a check, and you don't have to. You can make a contribution to the IRS. Personally, I think I'll go to the, Williamson County Animal Shelter or something with that money.
Yeah.
I'm going to be better used, I think. All right. Helping me today, with me today, is my good friend and special guest, Dr. Friday, with Dr. Friday's Tax and Financial Services in Brentwood, Tennessee. And, one of the things that with its new tax laws, and of course it keeps us on our feet, on our toes, I should say.
It's exciting.
Keep up with it. I like it. I mean, I love learning new stuff.
Well,
so
that's
it's always
it,
fun.
and that's what we get along. But for the 20 plus years I've actually been practicing doing taxes and compromises and things with the IRS, tax law hasn't changed that much. We've had little band-aids here or there. This is the first time in 30 years, so in my lifetime, that we've seen a serious tax change.
Yeah, significant, major changes.
This is some fun stuff. Some people are going to like some of it. Some we're still scratching our head saying, okay, how are we really going to apply this, because we're not absolutely sure how it works. And then other things I think are great that they're trying to make it easier on the taxpayer. A lot of people are sitting there going, but wait, why? How's this easier on me? I'm not saving. I'm no longer doing this form, so therefore I'm losing something. That's the mental concept. If I don't itemize, I'm not getting what I should be getting. I'm going to pay more in taxes instead of absorbing the entire big picture, right? Because the fact that he's increased the standard deduction by doubling it almost in most cases from the 6.65, well, we have 6.7, I think, or whatever, to $12,000 to $24,000 for a married couple. You have some changes, and you just have to kind of adapt that in your paychecks. You should be seeing, as of this week, if you haven't already seen some of the changes, the new payroll tax code has changed, so that's exciting too. I mean, people get to see that money in their pocket now.
There you go.
So what should we do with it? We've got all this savings, Hank. What are we going to do with it?
It's going to be nice to have a little extra money, right? So one of the things that comes in, and the same thing when it comes to when we're looking at taxes, there are the new tax code, as Dr. Friday was just saying, we're talking about raising the standard deduction and doing away with personal exemptions.
Right.
Now, when I compared it, I looked at, for me, I'm working mainly with people, of course, that are either at, near, or in retirement. So we're getting at that point where 65 plus kind of thing is one of those areas. 65 plus, now everybody, of course, is preparing for retirement. If you're younger than 65, you get a $24,000 standard deduction for a married couple. If you're over 65, you get a little extra. You get about $1,250 per person as you go over 65. So for an age 65 couple, that's an extra $2,500, so it'd be $26,500.
Right.
One of the things when it comes to tax planning is understanding it's a progressive tax system. And what that means is simply this. So when we look at that $26,500, married couple over the age of 65, standard deduction, that means you pay no tax on the first $26,500, okay, of your income. Now, when you're looking at Social Security, understanding there's also a provisional income formula. So again, when it comes to strategies, we look at what your total income is, how much of your Social Security benefits are subject to being taxed, okay? Right. You might fall into where zero of your Social Security benefits are taxed, or you may, which means, you could be making, in other words, that $26,500 is not taxed, The provisional income formula, however, is a little different. What it does is it states if you make, if you take half of whatever your Social Security benefits and you add those in to other income that you have, and if that exceeds for a married couple,
32.
I believe it's 32,000. So if you cross that 32,000 threshold up to, very key here, up to 50% of your Social Security benefits can be taxed. And it goes from 32 to 44, and at that threshold, up to 85% of your benefits can be taxed. Now, this is real important when it comes to tax planning.
But I
When
can
we
make
get
that more
into
complicated because you
Yes.
get the $26,000 standard deduction plus the first 19.5, is that what, 10%?
19,050, yeah.
1950 and 10%. So then you have that you have to subtract the 2650 from the 32 to get into a taxable bracket.
Well, when you're looking at that 20, so if you're looking at income, and the provisional income formula is tricky.
It is tricky
does,
because you're not looking at 100% of your Social Security. First thing you have to do is take 50% of that and then add it to your other income, which is different than the tax code itself.
Exactly. So you could find that you have, depending on what the effect is on your Social Security benefits, whether that's going to fall into that 26.5 that is zero tax, or if it might cause it to be taxed at 10% or what it might be.
And that's where.
And this is where require minimum distributions when we come into planning there.
Or Roth
when that comes at
conversions.
70.5, Roth conversions can be a way to reduce future taxation, which when we're looking, this is where looking down the road for tax planning is so important.
Because, I mean, you decide you're going to sell stock and you think, oh, wait, I've heard there's a 0% capital gains rate and I don't ever pay tax on my Social Security normally because it's below the threshold. Next thing you know, you've got $15,000 worth of capital gains. Boom, now it's almost dollar for dollar. Maybe you were right there, so now $1 of your Social Security plus the capital gains could make it taxable. Even though the capital gains rate could be zero, you now end up paying taxes because you've kicked your Social Security into a taxable situation. So just making sure you understand how those numbers kind of work can make or break how much you're going to pay in taxes is what it comes down to.
And this goes when we're talking about planning, we have to look at not just the straightforwardness of the tax system, well, if you want to call it that, I guess. If you understand the progressiveness of it, anyway, if you understand, so let's go back to the basics, all right, $26,500 for that married couple over 65, zero tax, all right, so that's now $19,050 of the next $19,050 over that, taxed at 10%. Right. So that means if you made, if you add those two together, you've got about $45,000, $45,550 that you paid $1,905 tax on.
Exactly.
All right. So think of that now, $1,900 tax. So now your actual income on that, of course, again, is 46. So your tax rate comes in at something like 4%. I think, or something
4 or 5%.
like that,
Yeah.
your tax rate. So here again, now the next bracket is 12%. Now this is where, when we look at the new tax code, we've got $26,500. So it's raised. Let me compare that, by the way. 2017. You had, for the same age 65 couple, you would have been at approximately $23,000 with your standard deduction and the exemptions, the two exemptions.
Right.
All right. So this year, without the exemptions, okay, the standard deduction is still giving you a benefit, an extra approximately $3,500 that you're not going to have to pay tax on at all.
Right.
Then it expands out by a few $100s, the 10% bracket, so that there's another few $100s that you're only paying 10% rather than 15%, the way it was for 2017. Right. And then now we have the other big change is that we're going, instead of a 15% bracket, it's been reduced to 12%. Right. So again, everybody's going to benefit.
Again, you got 3% saving. That's it. Anyone that's hit the 15, you're now going to be 12. Plus, you've got the additional $3,000 some dollars that they've given you in earnings that you can still make a tax-free dollar amount. So that's why I think until you start getting up into the higher brackets, you're really going to see, and even them, everybody went down some percentages, so everyone's going to see it because again, it's a progressive tax code. So everybody starts at the 0 to 10% and works their way up no matter what income bracket you're in.
You're looking at basically with this new, and by the way, so we're talking, if you to go from a 15% bracket to a 12% bracket, that 3% difference, that in reality what that means is a 20% though reduction in your taxes.
Exactly.
Okay, as far as the dollars go. Right. All right, so this is a big thing. Now think of it, here's another way. I ran the numbers. If I maxed out the 12% bracket for a couple age 65, that would be $99,000 for 2017. they would have had a 10.5% effective rate if they maxed out what was then the 15% bracket. This year with a 12% bracket, the effective rate's only going to be about 8.6%. So again, you're looking at a 20% reduction in your in overall taxes for those maxing out that bracket. All right, we're going to take a break. When we come back, I wanted to kind of fill you in on some of the changes, but we're going to get into more. There are more changes on the code, but also we're going to talk about how many of the strategies that we applied in 2017 and that we're going to talk about for filing your taxes this year are still going to also be available to you in 2018 with some added benefit, in fact, on top of it. So join us here. We'll be right back on the Retirement Report.
This is a Storm 5 HD weather update. Sign up for weather call.